Good morning. Gonna give it a few more seconds to let people in. Hope everyone morning going well. Sweet, well, we're gonna get started. Hello everyone, thank you for joining us. My name is Caitlin and I'm on the marketing team for Sensiba San Filippo. Just a few housekeeping items before we get started. First, we are recording this session. We will be sending both the recording and the PowerPoint after we have concluded. Please utilize the Q&A box during the webinar so our presenters can answer the questions you may have. And with that being said, I will hand it over to Cole and Ariane.
Thanks, Caitlin. Happy that everybody's here today. We're going to talk about the employee retention credit, the ins and outs of it, give you a good idea of what's going on with it, the timelines, and why maybe you don't need to be in a huge hurry. We wanted to talk to people and let them know where we are in the timeline of claiming this credit, how you would go about it now, and then we'll dig into those details in a little bit. But as I should have mentioned off the top, I'm Cole Marr, I'm a Specialty Tax Director here at SSF, and I've got with me Ariane, who will introduce herself.
Good morning, I'm Ariane Woods. I am a manager here at SSF, also in the Specialty Tax Group. I will be running the Q&A today. So Cole will do the talking, and then if you've got any specific questions, please throw them in the Q&A so we can take care of those. And then if there's any specific questions about your company, our contact information will be available at the end when we send this out. And so if you've got specific questions about your company that you don't want to share in this forum, we're happy to have a conversation offline.
Yeah, that's a great point, Ariane. And I think at the after this presentation, when we send it out to everybody, we're also going to include at least my Calendly link. If people want to have a further conversation about their situation, they'll be able to schedule a time directly. And I love having those conversations. So everybody's welcome. So for today's short presentation, we're going to try to be short and sweet. We got it scheduled for a half hour. We're going to give you enough information, hopefully, to make you realize whether or not you should dig into this opportunity further and whether or not it could make sense for your company. We'll go over the timeline and why you've probably heard conflicting points about the ERC, right? Many of you might have looked at it previously and decided you didn't qualify. And gone back and forth. An additional reason for having this presentation, getting more information out now, is there's a lot of marketing around this credit still. A lot of firms, there's radio commercials, I've seen TV ads, various pieces of marketing material. So lots of people wanting to talk about the employee retention credit. And I think it'll be clear as we go through this presentation when we talk about the opportunity, why that is. But we want to make sure you understand the whole of the opportunity and figure out how to figure out where you need to go with this credit. So a little bit about the timeline and how we got here. This credit has been legislated, or I should say was legislated in several different pieces. It's changed several times, as you see, 3 different major pieces of legislation with countless FAQs that were issued by the IRS, directives, advice, things of that nature to clarify what took place in a lot of this legislation. But throughout the history of the employee retention credit, largely each time it's been changed, it expands the footprint or it expands the opportunity of the credit. At the very end, that last piece of legislation, the Infrastructure Investment and Jobs Act from September of 22, actually retroactively repealed the 4th quarter of 2021 opportunity. So when we talk about this opportunity, you'll see that it's 2020 as an opportunity, and then there's at least 3 quarters of opportunity in 2021, except for a special carve out for a particular type of business, which we will get into. Those are the periods that we would be talking about. So if we go forward, the reason this opportunity is so valuable, and the reason there's a lot of people probably marketing to you at your company, you're seeing advertisements about this, as I just alluded to, is that it's a fully refundable payroll tax credit. And what refundable means is that you don't have to have tax to offset to get money back. So traditionally, you have a tax credit, you have to have tax due to offset to get money back. In this scenario, if you qualify for the credit, which we'll get into, you quantify it, you make a claim, you can get the entire amount back, even if it's much more than the amount of tax that you might have had due in the particular time period. And in fact, almost by definition, with this credit, you'll generate much more credit than you had tax due in the period, which is why the fact that it's refundable makes it so powerful. So this is a payroll tax credit. So it's actually claimed via, at this point, a 941X. We're outside of all the timely filed potential opportunity for this credit, but you can go back and file a 941X, which makes a claim for this credit and would trigger a refund for you. At this point, there is also most likely a requirement for you to file an amended income tax return, which is where the tax impact of this credit is really picked up. And we won't get into all the ins and outs of that. That's really a tax advisor specific question, right? Your CPA would have to help you understand, is an income tax amendment required? What is the best timing for that, et cetera. But none of that is necessary until you figure out if you qualify for the employee retention credit and if you can make a claim in the first place. So this is the ERC overview, and we have this slide at the end as well, because I think it's an important summary, but I wanted to show it at the beginning before we dive into each one of these sections individually to let you know, you don't need to take detailed notes when I buzz through each one of these sections. What I really wanted to point out here was that there's 2 time periods, and on each of these next 3 slides or so, we'll be talking about 2020 versus 2021. And how the thresholds, the amounts, the qualifications in those time periods changed. So just keep an eye on that, and we'll walk through some of that. So as I mentioned, these slides are laid out with 2020 on the left, 2021 on the right. So we talked about fully refundable tax credit, but how much is it, right? That would be the next question. So in 2020, the credit is a 50% credit on up to $10,000 of qualified wages and employer paid health plan expenses. So it can be that the headline number is $5,000 per employee.
For the whole year.
For the entire year, and 2020 being one period. So you can potentially qualify and generate the credit between March 12th of 2020 and the end of 2020. So at any point in there, if you qualify during a certain period, which we'll get into in a following slide, you can generate up to $5,000 per employee. So then we go forward to 2021, and it's a similar idea, but the credit was actually made more lucrative, right? So it's a 70% credit on up to $10,000 in qualifying wages and health plan expenses per employee per period that you qualify. So you could potentially qualify for Q1, Q2, and Q3 separately if you qualified for all 3 of those quarters and maxed it out per employee. That would be, 7 times
21,000.
21,000. I was leading up. I was going to get a big reveal, but thank you, Ariane. $21,000 of potential credit per employee in 2021 if you maximize the opportunity. So who is eligible, or maybe we should say, how do you become eligible for this credit? How do we know if I can access this valuable opportunity? So in 2020, you needed to either be impacted fully or partially by a government mandated shutdown order, or, and that's a big OR with an underline, not and, or you needed to have experienced a significant decline in gross receipts, which in 2020 was defined as a 50% reduction in a particular quarter compared to the same quarter in 2019. So if we're looking at Q3 of 2020, if our gross receipts were reduced by 50% or more compared to Q3 in 2019, we're qualified for at least that quarter. And then you continue to be qualified for some period of time. I'm not going to bog you down with the details of when that qualification ends necessarily. suffice to say, if you have a 50% reduction, you will qualify for some period in 2020. So then moving on to 2021, you still have the same fully or partially suspended qualification opportunity, or in order to meet the significant or substantial decline in gross receipts qualification, you need to have experienced a 20% reduction in the quarterly gross receipts as you report them for tax purposes between the same quarter in 2021 and 2019. So same example, we're looking at quarter 3 of 2021, compare that to quarter 3 of 2019. If you experienced a 20% reduction, you qualify for quarter 3 of 2021. There are some caveats to that. As I mentioned, in 2020, when does the qualification end? So in 2021, you have the opportunity to look back to the prior quarter to qualify for the current quarter. And there's also some interesting detail around the fact that if you qualify for a quarter based on the significant decline in gross receipts test in 2021, you will also qualify for at least the subsequent quarter. So if you qualify for quarter 2 based on the 20% reduction, you'll automatically qualify for quarter 3. So it's an important detail to remember there. And then we want to talk about what is eligible. So this gets at the size of the company. That was a pretty big change that was made between the 2020 and 2021 opportunity. So if we're talking about the 2020 ERC opportunity, if you had 100 or fewer full-time employees, and let me point out here that this is a discrete full-time employee count from 2019, average by month in 2019. This is not a full-time equivalent calculation, like many of you probably were experienced with the PPP applications and PPP forgiveness calculations. So this is a discrete full-time employee count on average by month in 2019. So if you were below 100 in 2019, your 2020 opportunity is the most expansive. Fast forward to 2021, they moved that threshold to 500 full-time employees. So in 2021, as long as your headcount was below, for 2021, as long as your full-time headcount was below 500 employees, in 2019, you would be able to access the maximum credit opportunity for periods in which you qualified.
And this is actually, we've had a number of clients who we've run these numbers for, and they've got they have churn in personnel. And so while they may have had 130 people on staff throughout the year, in any individual month, their full-time count has been well below that 100-person threshold because they just have enough turnover in their staffing. And so they've been eligible when you look at it by month, even though if you look at the full year, the count is over when the monthly count is below. And so that's actually a very important thing to be able to calculate.
Yeah, that's a really important point to highlight is, that average per month, right? Because we've had a lot of clients that were growing maybe aggressively in 2019. And at the beginning of the year, they had 50 employees. And at the end of 2019, they had 150. But it's not until you do that average monthly count, you can figure out whether or not they were below 100 in 2019. And then that, by the way, that is the limiting factor on what your opportunity might be for 2020 or 2021. If you were below 100 full-time employees in 2019, it doesn't matter how many employees you have in 2020. And it doesn't matter how many employees you have in 2021 with the 500 threshold. It only matters during that comparison period. And then that's an important thing to think of too when you're thinking about qualifications for the employee retention credit with the gross receipts reduction, et cetera. It's always, things are always compared to the pre-pandemic period of 2019. So just to round this out, if you have more than 100 in 2019 or more than 500, if you're looking at the 2021 opportunity, the ERC is reduced in scope to you'll only be able to generate credit for time in which your employees were not rendering services but were paid, if that makes sense. So in the example being in 2020, let's say you had a sales team that traditionally traveled around and spent a lot of time on the road. They were able to do 50% of their job remotely at that point in 2020. but we continued to pay them. You know, they weren't necessarily furloughed or laid off, but they were just really only rendering services for the company half the time they would have normally, but they were getting 100% of their wage. We could then generate an employee retention credit on that 50% of their wage or 50% of their time for which you were paying them, but they were not rendering services.
And then, as Cole alluded to, if they are furloughed, it's an absolutely yes as well. So if you're paying people to be at home, to make sure they just stay on payroll. We had a lot of restaurants and other service hospitality clients that furloughed people to try to keep them on staff so they wouldn't have the attrition issues. And so we saw a lot of that in 2020.
Yeah, and on this slide too, maybe a good point to highlight, you know, there's a lot of focus on full-time employee count. We just talked about it for 5 minutes here, right? It's obviously an important point with this employee retention credit. When you have a period that qualifies, it's no longer limited to full-time employees. So in a period that you qualify in 2020 or in 2021, if you had a part-time employee, you had less than full-time employee, a new employee, whatever the wage they made in that period and health plan expenses that were paid in that period for that employee or on behalf of that employee can generate, you know, a tax credit. It's not an all or nothing thing where somebody made $1,000 in wages in the quarter that qualified in 2021, we can get a $700 tax credit, 70% of that $1,000. So that's the way it works once you actually pass that qualification threshold.
Speaking of qualifications, there's one more way to do this, Cole.
One more wrinkle. So we mentioned early on that largely the opportunity was limited to 2020 and 3 periods in 2021. Well, the caveat to that is if you were defined or if you meet the definition of what they came up with in that last tranche of legislation, a recovery startup business. So what is a recovery startup business? A recovery startup business is a company that began operations after February 15th of 2020. Important point to highlight here is that the definition of began operations may not, and in many instances is not the same as the incorporation date. So it might be effectively the same as the incorporation date, but it doesn't have to be. So that is something to keep in mind here. So with this category, if you were founded after February 15th, 2020, your business and your gross receipts were below on average $1 million, which is something that I think we left off this slide, I apologize. Your business will qualify, assuming that you meet those 2 guidelines. So what does it qualify for? Most of the factors are the same, right? The way that you calculate it, but there's a lower limit on the amount of credit that you can generate. If you qualify via the ordinary means we were just talking about, there's no limit to the amount of credit you might generate if you qualify. If you're a recovery startup, the limit is $50,000 per quarter. So we're talking about $100,000 worth of opportunity per quarter if you're a recovery startup. It doesn't matter how many employees you have above and beyond what might have generated a $50,000 credit. The total credit amount is capped at that $50,000. But it is a nice benefit, and this is the only category of business that will generate an employee retention credit in Q4 of 2021. So it's a small detail or somewhat small opportunity in the grand scheme of what's going on with this employee retention credit, but it can be a very powerful and a very valuable opportunity for businesses that meet this definition. So having walked through all that, we just wanted to lay out a bit of the process. If you're thinking, well, I do qualify, or maybe I qualify, you know, what are the main steps that we need to go through, right? So the first is what we've been talking about, determine if you're eligible, and then you want to determine if you paid qualified wages. And we'll get into a few details on the following couple of slides about some caveats and some things to look out for on the question of, do you have qualified wages? And that largely has to do with the PPP loans and how those interact with the employee retention credit. We'll cover that in a bit. So then once you figure out if you qualified, what are the periods? Do you have qualified wages? You need to calculate the credit. I think that's maybe pretty clear. At some point, you need to calculate it, get those numbers, and then it is claimed through filing a 941X or an amended quarterly payroll tax filing to make the claim to get the check back for the employee retention credit. So,
And it is a paper check, like this is a paper process with the
that
IRS.
is a fun fact. So our next set of slides is titled Fun Facts, and maybe that should have been a fun fact. That's like the headline.
I hadn't thought of that one.
Is so what, you know, let's jump to the end. When you file a 941X, just so everybody knows, you have to file a paper copy. And then once it's processed at the IRS, which we'll talk about timeline here, you'll get a paper check in the mail. So kind of a quaint idea.
Those can be very, very nice numbers as well. So we've seen some pretty big size checks, and they come on that fancy rainbow colored paper with the silver strip. It's pretty cool.
Yeah. So as we talked about, or could have been inferred from our opportunity slide, is this is available to companies of all sizes. You know, it's just limited based on how big you might have been in 2019. Relative to the government mandated impact, the shutdown order opportunity, and the gross receipts reduction qualification, there's no requirement to prove harm or a relationship, right? We don't have to say like, well, yes, we experienced a gross receipts reduction, and then show that it was because of an impact from COVID-19. They've allowed some flexibility in that, you know, there was no way to know from the outset how all this was going to unfold. You know, it was a layer of complexity that I think fortunately they removed, right? As we don't have to prove that the gross receipts reduction caused specific harm to the company. Same thing with the shutdown orders. We have had companies that were impacted by shutdown orders that continued to find ways or navigated around them and in various ways. They continued to have a thriving business. They just were impacted by that shutdown order. So the third bullet here is an important one to discuss because there is a lot of, I won't say a lot of confusion, but some confusion around this, right? Originally, when this credit was legislated, you could not have a PPP loan and claim the employee retention credit. That was changed in the second round of legislation to make it so that you could have PPP and qualify for ERC. You just have to make sure you're not double dipping on the same wage dollars. So the idea of it not being the same wage dollars is basically where the opportunity comes with maximizing the employee retention credit. So there's a very simplistic way to think about this, in that if you have PPP dollars and you qualify for ERC, you can't have them in the same time period. But that's too simplistic a way to think about that. Because when you filed for forgiveness for your PPP, or if some of you are still filing, there are still a few companies that haven't filed yet, there's no requirement to make a specific allocation of which wage dollars are used for forgiveness. So if you can envision, you know, the different programs overlapping, Venn diagram type of scenario, right? Different thresholds, different qualifications and guidelines, et cetera, for the forgiveness and for the potential timelines and who can generate employee retention credit. If you allocate all those dollars in a detailed way, you can protect and you can get your full PPP forgiveness and maximize the employee retention credit opportunity. So that's what our calculation team is really spending a lot of their time doing, is making sure that opportunity is fully maximized and that nobody's endangering their PPP forgiveness along the way.
We are getting a little tight on time. If you want to speed up to these last several, please.
Yeah, no problem. So just real quickly, if you acquired a business or maybe you disposed of a business, right, that can interfere with your 2019 time period or base period. So you can make some adjustments as to how that would factor in and allow you to make an apples to apples comparison and potentially still qualify for this credit. If you're in a service industry, tips are considered eligible wages when they're reported on W-2, of course. So if they're flowing through on there, then they're potentially an eligible wage that could generate employee retention credit. credits for Q1 of 2020 actually don't require an amended 941. Those can be put on the second quarter of 2020. So a little less administrative headache on that front if you have a Q1 2020 ERC. So for furloughed employees, those can be includable for the period of time that you both qualify and they were still on the payroll. There's not a major rush, right? That was another message we wanted to get out today. And one reason why we wanted to have this conversation today is, the end of the year is not a deadline for this credit. It's not a program that's going to run out of money. This was legislated. It was given a little bit longer statute of limitations than some credits and some things in the tax world. So you have up to 5 years to claim this credit, theoretically. So most people have an opportunity, if they've missed it, all the way up until some point in 2026. So no huge rush other than, if you qualify and you have some money coming, you'd love to get it in your hands sooner rather than later. So once you file that 941X, make your claim. It's taking a while to get these refunds back. And in this presentation, we're going to tell you it takes 5 to 8 months, kind of a long range. We've seen a range of times, but they are getting better. So about a year ago, they were taking 9 or 10 or longer months. So the IRS has got caught up a little bit with the backlog. And I've seen some people's claims coming back in as little as 3 months or so, 12 weeks. So there's some hope that it could even be quicker than 5 to 8 months. So that's the timeline you're looking at, though, once you file a 941X. So just a couple of the last bullets here, just on the idea of double dipping, right? So they wanted to make sure that you're not getting double benefits on things. So in 2020, if you took any paid family and medical leave credits or had any work opportunity tax credits, you've got to make sure they're not interfering and you're not double dipping on them when you're taking the ERC. And then additionally in 2021, they expanded that net of credits we want to make sure we're not double dipping on to several various credits, including the research and development tax credit, to make sure you're not double dipping on any of those benefits and claiming this ERC. So we also want to mention some limitations. So there's an aggregated group requirement, which says that if there's 50% or more common ownership, the companies need to be evaluated together. So even if the companies don't operate together, the people that work at the companies don't know anything about each other, if there's 50% common ownership, their gross receipts need to be aggregated, shutdown order impact evaluated together. On the bright side, if the group qualifies, all the companies in the group qualify. And you can calculate or not calculate on an individual basis, depending on the group qualification. And then there is an exclusion for owners. So 50% owner, 50% or greater owners, and then their direct relatives, as defined pretty broadly, as you see here, child, sibling, parent, in-laws, etc. None of those people can generate employee retention credit as owners or as relatives of the owner of a company. So, and I alluded to the last point earlier, this was legislated a couple of times. There's been a lot of clarification put out, IRS guidance, FAQs, etc. The tax law itself is not extraordinarily detailed, but the IRS has put out several rounds of clarifications, which is why you'll see a wide variety of ideas relative to who qualifies for this credit. And with all that marketing material you'll get in, you're probably receiving, you'll see a lot of different opinions about how people can qualify and who can qualify, especially on that government shutdown qualification. And then that's the one that I want to leave you with a message of, buyer beware. Make sure if you're going down the road of a government shutdown qualification, you truly understand what's involved and truly understand why you qualify. And just want to put that summary slide back for you, so you'll be able to refer to that. And I think we mentioned everybody will be receiving a copy of this presentation. I think my Calendly link will be in the email that gets sent out. So if you want to schedule time to talk about this in greater detail, have questions about your potential qualification, any of that, feel free to schedule a time. We're just happy to have had you here today. Appreciate your time, and hopefully we clarified a question or two. Ariane?
So I'm going to add that I've answered a few questions in the Q&A, and one just came in. Cole and I both have a few more minutes. We are at time, so if you want to drop off. Otherwise, I'll run through a little bit of the Q&A, and then there's one that just came in that I'll get to. Again, if you did not have a governmental shutdown and you don't qualify under the gross receipts reduction test, you are lucky and unfortunately don't qualify for this credit. So this is one of those issues where we've had a couple of clients that are sitting there at 19.98% reduction, and there's nothing, and we're very sorry, there is no opportunity for you. Additionally, I answered another question for an attendee about the PPP loan overlap. Depending on your industry, if you've got a very high ratio of people to the PPP amount, a lot of times, let's say you've got a $1 million PPP loan, but in the covered period, you've got $2 million worth of wages. There's lots of opportunity for ERC there. Additionally, a number of our clients are in fairly high compensation areas and in technology. And so if you have someone who's making over $100,000 a year, PPP only lets them take up to the first $100,000, that pro rata share of it. And so that amount over that is fair game for ERC if they otherwise meet the qualifications. And then, as Cole mentioned, we are seeing sometimes as short as 3 months, but really at 5 months is when we recommend that clients start putting the time in to call the IRS and just finding out where in the process they are. And then one just came in. Oh, never mind, that's not a question. Thank you. So we've got some new hires. One of the attendees has some coworkers that have recently joined the firm. So if there are any questions, we're happy to take them. Otherwise, thank you. Thank you very much to everyone for attending.
Yeah, thanks everybody. We appreciate it.